Hi, welcome everyone. Thank you for joining us for today's webinar. Today we are presenting the US, Thailand, and Indonesia outlook by Ms. Peggy Mark, the CIO of Philip Managed Accounts. So just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the Q&A tab, which can be found in Zoom control panel. As for those who are joining us from YouTube Live, you can raise your questions at the comment section. The speaker will pick some questions to answer after they end their presentation. You can also find the recorded session on Philip Capital YouTube after the end of the webinar. If you do not have an account with us, do not hesitate to go to www.poems.com.sg and click on Open an Account, and you can register a trading account within minutes with my info. So we will start the webinar now.
Evening, everyone. Hi, thanks for dialing in and thanks for choosing to spend your evening with us today. My topic for today is about the US market outlook. I will also be touching briefly about Thailand and Indonesia, more to highlight how the current crisis is affecting the emerging markets. But the more important one, we'll spend a little bit more time on the US market. I titled my self-inflicted recession. I think when I go through my slides, you understand why I think so. But as we know, the whole entire world is probably going through a recession this year. But I think US has a little bit of their own doing in it as well. Okay, let me go quickly into my slides. Okay. US market facing a triple whammy. Okay, we did not expect the virus outbreak, right? Firstly, just to point out, but we were wary about the US market since last year, especially when the trade wars started to get louder. Okay, the US market was why we call triple whammy. The first thing on the macro backdrop was trade war was already really weakened the consumer the side of the demand, and then on the market conditions, the S&P 500 continued to run and hit a peak in February this year. If you look closely into the S&P index, it's actually the bulk of the composition is occupied by taken up by 5 components, and that accounts for about 20% of the total index. So there's a very heavy share of leadership stocks in there, and most of these are, of course, in the tech stocks. It reminds us very closely about especially during the year 2000 when we had the dot-com crisis. I'm not saying that we see US facing the same situation as the dot-com, but I'm just saying that the scenario looks very similar. And then now we have this uncharted events, this coronavirus outbreak. The way we saw China handle it, we thought the world could learn something from it. Having a 2-month lead time, there's some preparation that they can do. But apparently, US was very ill prepared. Okay, let me go straight to the one focal point in the market right now is this chart, the daily new cases. I'm glad that today is my turn to do this webinar because the chart managed to take a deep downwards, so there's some kind of comfort there. But then this morning when I checked the 30th March numbers, it crept up again. So I really have no heart to revise this chart. So let's just keep it here, and hopefully next few weeks the chart will flatten out. The flattening out of this chart, of this graph, is really the most important point the market is looking out for. It's just solve a lot of our problems that we are facing, the shutdowns, lockdowns, all the quiet streets, the disappearing tourists. Okay, now this is the S&P 500. Okay, we faced a bear market from 20th of February, even though the first China so-called the case gets broadcast in late 1 month before that, which is about January 18. Okay. The rise in the S&P, you can see that it has been all this way up. There's only a brief dip in late 2018 when the trade war looks really close, right? The rise of this S&P 500 can be attributed to two reasons. One is it's been propped up by the share buybacks in the market, right? And the second thing is, of course, Trump had a tax cut introduced for 2017, which applies to 2018 and early 2019. And now this tax cut is behind us. The share buybacks make sense in that during those times when cost of equity well exceed the cost of debt. And unlike dividend, shareholders do not have to pay tax on for share buyback. So it benefits the market as a whole. But in the current environment, when credit tightens and cash flow becomes the top priority, share buybacks, like the tourists on the street, will be missing. And this is how the markets reacted after the virus outbreak. Okay, the green portion was the point from January 22nd to Feb 18 when China was coping with the outbreak. Right, at that time, during this period, China was still Shenzhen index was still up. The two US S&P 500 and Dow Jones are still higher, still a growth. But soon as Fed 19 comes by, everything just goes downwards. The last column, you can see WTI. That's the crude oil price. That has gone down 70% from beginning of the year. Oil is significant to US, mainly because US is now the biggest producer in the world. There is ahead of Russia and Saudi Arabia. So when when Russia and Saudi Arabia fight to over the how to improve on how to raise the oil price, or how to when they fight on how to curb whether to curb the production or not. Actually, US is the one who should worry the most, because this is the comparative valuation to date. See, you can see the different markets. In terms of PE ratio, they have all come off. Singapore is now trading at 0.87 times price book with a dividend yield of 5%. And US is still relatively higher than the rest of the markets in Asia, even higher than China. And yeah, so comparatively wise, we find that it might have a little bit more room to fall. Okay, this is how the trade war was looking, and it's actually weakened fundamentals, although Trump thought it would make American great again. Okay, so this was the schedule for the trade war, and then actually most of the increase has been carried out up to 250 billion of imports into that US bought from China has been now levied a 25% tariff. There was some suspension for the remaining 300 billion, but that doesn't really help. That helped actually. If it's not for that one, the whole economy will probably be in recession even before the virus attack. But still in this year, there's still some tariff imposed on the EU for the some products. Okay, so that's the main thing that has affected consumer spending, and consumer spending accounts for 70% of US GDP. So this is how US GDP growth looks like after when trade war started. So you can see that from third quarter 18, the growth has actually slowed down. down to about 2.3%. But first quarter this 2020, it looks like it's going to be a negative 2%. And second quarter, likely another 9% for a negative 9%. So for the whole year, we think China, guys might come in at about a negative 1% recession. Okay, so trade deficit wise, yes, the trade war has actually improved on this, helped them to improve the trade deficit. But most of this shrinkage is more because the import has actually stagnant. Although export stagnant, but import has dropped. So therefore, the smaller deficit. So it doesn't achieve the purpose that Trump wanted to achieve. Okay, this is the more telling chart. Industrial production actually fell since September 2019. Okay, this is the number to show that the manufacturing has been slowing down. It has been in a negative zone for several months now. This month, although February it was a 0% year-on-year flat, but looks like February after February everything is just going straight downwards, especially with the shutdown and the supply disruption coming up for the goods coming out from China. Okay, this manufacturing PMI has fallen to below 50. In terms of wage growth, the last number shows still a wage growth of about 3.2%. But from this chart, we can also tell that wage growth has actually been falling. And this latest wage growth has actually been achieved for the lower income group. So lower income group, if you add a 3% compared to a higher income group with an addition of 3%, it makes a lot of difference. Higher income group that earns 3% more could spend much more into could have a bigger spending power compared to lower income. The consumer's confidence straight after the virus was announced has actually plunged. This is the number that is worrying because it is actually also trying to match, is probably matching the number we saw in 1927, late 2016, when we had a very, very depressed oil price. This is a shorter chart for retail sales. You can see from December, after December, there's been coming off. Most of this is actually driven by the concern over the higher cost of imports for the consumers. And then on the longer term chart, you can see the fall is also quite pronounced. One thing to note from this virus outbreak is that the world is actually starting from a much weaker position than the last time we had the SARS. So during SARS time, in 2002 to 2003, the world GDP was growing about 4.6%, and last year we're starting off at 2.9%. So we are already on a weaker footing. In terms of world trade volume growth, last year and to early this year, negative 1.2% compared to 8% during SARS. So our view is that if the virus will be to go away, the world economy, the recovery will also be weaker than before. Okay, so virus. So what do we do during a virus event like this? Two important things to remember. Don't stay away from the beach and don't lie on the bed. Okay, the beach. What the beach are? The booking companies, entertainment and live events, the airlines, cruises and casinos, and hotels and resorts. The total market cap of these companies in these sectors in the S&P 500 index actually shrunk by 332 billion over the last 1 month. And this accounted for part of the decline in the S&P 500. The rebound could be depending on how the virus, how we get over this virus issue. We take the SARS memory, the rebound was very, very sharp during that time. It was the pent-up demand. The airlines bookings just shot up, almost rebounded immediately. So this time it might be a bit more tricky, as we see the China, even after it looks like they have overcome the problem, they're still being very cautious to make sure that there's no second wave of rebound in the number of cases. So the sharp rebound that we saw in SARS during SARS time might not be happening. And the bids, bids are those they might not be listed. Most of these are companies that burn cash. They could be private equity funded. I hesitate to put the words disruptive here because it's not necessarily negative, but there's quite a number of companies out there who claim that they are disruptive, but actually they're just adding more capacity into the system. Okay, and then of course those who doubt, who's in the sharing arrangement. Okay. So the cases I bring out, the reason why I bring out this is that most of these companies are private equity funded, and private equities were easily available because of the low interest rate. But during this current environment, there's a greater need, tightening of the credit is asking, it's a greater demand for higher risk premium. So the investors, the private equity investors might not be as patient as before. So these companies who are in this space might find fundraising difficult. So if we were to see a bubble, this would be the more immediate bubble. This is taken from a McKinsey report. According to them, the most affected sectors, which is also outlined by the list that we shown in our previous chart, previous slides, tourism and hospitality. And the line Q4 is the time frame that they think it will recover. The recovery will be slowest for tourism and hospitality because of the severe ripple effects. And then next will be aviation and airlines. They might recover earlier, but it still will be late Q3 and early Q4 because of this sustained headwinds. The oil and gas might be earlier than Q3, provided the oil price recover. Current scenario doesn't seem to point to that. Okay, on longer term, there's a demand impact as the demand switch over to renewable energy, and also we have a short-term supply overhang. There is this supply overhang is it can be I wouldn't call it resolved. It might not happen if the virus spread more widely into Middle East and affect the other oil producer. Of course, nobody wish for that to happen. Okay. So and then the fourth one is the automotive. The recovery will be in late Q2 to early Q3. Because existingly, there's some vulnerabilities. Part supplies coming from China, and China is also a very big auto market. They take up 25% of the world's output, and the trade tensions actually auto is one key product that has been targeted. China has been emphasizing a switch towards electric vehicle. So the current producer will have to change their revenue model and change. Then the supply chain is also being disrupted since the virus started in China. Production disruption means that it will not just be China alone. It will affect the rest of the world. Okay. Then consumer products, Q2, they see some recovery. Mainly because these are essentials. For instance, food products that are resilient, and there's also a switch into online services. So online growth has been very significant, and although it's hampered by the labor shortage. In Q2 recovery, they also expect consumers electronics and semiconductors. This we think, especially for semiconductors, will be the next one to drive the market recovery. The market structure has been shifting and actually has accelerated. We see downstream there might be an impact due to supply chain challenges in China, but next wave to drive, next innovation to drive the recovery will be 5G. Most of the countries have already put in their 5G plans this year. China has the three telcos has invested 180 billion into 5G rollout for 2020, and Singapore is also going to announce the 5G contenders. In 5G, together electric vehicle and the greater demand for cloud and online services will drive semiconductor the pace of recovery. Last year, semiconductor had the lull will start to be resolved this year. We spoke to some semiconductors producers. They told us that they have a 6-month order book lag time. Nobody is cancelling orders even during this time, because if they know that if they cancel and they need it again, they have queue 6 months later. So the order is still intact. Okay, so what happened when the virus outbreak? The first thing, the market, the governments worldwide, they move very quickly to address credit market troubles. Fed funds cut the rates 150 basis point to a zero lower bound. Okay. And they're also very aggressive with fiscal stimulus. In some countries, even roll out several rounds of stimulus. And so the market reaction in that the price decline is more because we are to be able to discount the risk and determine the dent to corporate earnings and the floor valuation for equities. We need the rates to stabilize, and we also need to know how far, how much, how soon this stimulus will be rolled out. So therefore, you see market volatility in over the last 2 weeks. Okay. Now there are 2 wild cards here in the market that poses greater risk. That pose greater risk. First is the corporate leverage, which actually has gone up, but we don't exactly know how far that it has been. That will affect their interest repayment. And there's an issue with cash flows. You know that revenue growth is no longer positive with these lockdowns. The interest service may not be feasible for some companies, so leverage has now become a big downside risk for the market. So the one point to highlight is the Fed, what they have reinstated, what they have done is actually what they like, for instance, cutting the rates and pushing out all these QE measures is really very similar. It's a similar playbook that they did, that they used during the global financial crisis, and this time is sharp, is more aggressive, and we can see that the global financial crisis, it worked. So Fed has actually used the same formula to hopefully help the market to ease the liquidity, to be able to for the borrowers to be able to to borrow, and this supportive monetary and fiscal policies to try to keep jobs and keep prevent the unemployment rates from rising. we see the 10-year Treasury yield has actually dived after the announcement. Okay, we believe that these QE measures might continue for another 4 quarters until the economy accelerates and unemployment rate drops. Then the Fed might then do some cutback. Okay, this is a longer term Treasury yield chart. You can see if you look at the chart, you can tell that we are actually at the lowest of the low. The question is, will it turn negative? We think it's unlikely. Fed said that he tried. The chairman said he tried not to make it negative, but it might dip into negative once it's about, but it will not stay there because there's a substantial money market fund in the system where it provides liquidity to the banks. However, even with the interest rates coming off, the policy rates coming off, mortgage rates are actually moving up because the lenders are demanding higher credit spread, and we think this is only going to rise. Now, the next issue to watch is the housing starts for US. So far, housing starts have also been going very nicely, but this data probably very outdated already by now, because if you look at the jobless claims, initial jobless claim, when unemployment rates goes up, nobody's going to buy a house or commit to a new house. Okay, this is the initial jobless claims. Chart is shocking. 3.2 million going in for claims from an average of about 200 over 1,000 per week. We heard that this number is going to double this week. Not sure whether it will happen, but it is shown that the risk of bankruptcies in the system is very likely, even for large and small, whether for large or for small company. Then financial market tightening will just exacerbate the problem. Some sectors are really strained. Retail sales ex auto was already down since in February. Actually, if you look closely at the trade war, the last year tariffs actually imposed an additional tax at the crucial time for the retail sector. So tariff was one reason. The virus added on to it. The oil price has fallen 66% year to date. Actually more like 70%. Actually, yeah. This oil price is significant because US is the biggest oil producer in the world, and if you go back to US GDP numbers for 2016 and 2017 to 2018, the sharp acceleration in the economy was also due to the rising oil price. So the oil play a big part in helping the economy to grow during those times. But don't despair. There's some rays of hope out there. And the macro-wise, these extremely low interest rates will ease off some pressure on borrowers. It's also help to keep asset quality. Help to stop the deterioration in asset quality. And the low bond yields that we are seeing right now actually makes equity much more attractive. And yeah, and market conditions, the sharp correction, which the speed of decline and the rate of decline is actually reminds it's very it's about the same degree as the global financial crisis. So when there's a decline, the rebound when the decline is very fast, the rebound will be much more nearer. Okay. And the third special event is that this election, and the candidates, they tend to spend during election time. So this spending hopefully will drive a multiply effect onto the consumer spending. Okay, so but the one so we monitor two numbers to see whether we are there for to we should be positioning to buy. Okay, one is the consumer sentiments. You if you had your currently it's 79.7. The last two numbers are 9.9. Actually, when he first announced the trade war, one is middle of 18, one is end of 19. And then during the global financial crisis, we were at 48.3, 49.1. Then after that, the market rebounded very sharply. In 2011, when we had the Euro sovereign risk crisis, this consumer index was at 45.7. And after that, we had 2 years of very good market as well. So we're not sure whether, I can't tell for sure whether these numbers will go down to 45. I hope it won't go there, especially with this election ongoing. Not likely to hit there, but it definitely, I think the consumer expectations will come down lower as the shutdowns affect our mental and physical comfort, and also the loss of jobs, the more news of bankruptcies and companies folding up will impact on the consumer sentiments. Okay, another number we watch also is the Empire Fed Manufacturing Survey. This has plummeted, not to the financial crisis level yet, but it's very, very sharp. So it just shows that the manufacturing, the retrenchment, the employees might be let go, and there might be more redundancy happening in the next 2 weeks. Okay, this is I put this from a sector valuation compared with the S&P. Want to highlight that 2019, actually when S&P was high, it's actually those sectors that are above S&P, like tech, communication services, financials. These valuations are, how to read this table is that these valuations are higher than the valuation of S&P 500. And then those below the S&P 500, the valuations are lower than S&P 500. So you look closer, it means that 3 sectors actually are heavy, are taking up the biggest weight of the S&P 500 index. Okay. So compare with 2014, for instance, S&P was those who those valuations are higher than S&P are the REITs, the utilities, the healthcare, tech, financial, and consumer staples. So we are back to my first earliest point that this 2019 it really reminds us of the dot-com crisis in 2000, where tech was leading in terms of valuation, and the 5 tech stocks actually took up about 20% of the S&P 500 index in terms of market cap. Okay, but I also want to highlight that we are actually in a different environment right now, where the migration to cloud, the innovation, the very big innovation wave they have seen in the last one year or so, actually drives the demand more for growth companies like in the tech sector. So tech therefore command a higher interest. But the valuation has to come down in order we feel that valuation has to come down to become to another to an attractive level before we will get in. Okay, you find this table very empty. Sorry if I disappoint you. We still believe that this is still good to stick to the defensive sector, like what in February we say the same as well. The defensives, and when will we go into cyclicals? Only when we see the chart, the virus daily new cases actually starts to flatten out. Then the cyclicals will be more attractive. But having said that, we still believe that there's a need to go into some growth stocks because of the 5G innovation, and of course the cloud, the online and e-commerce, online services and e-commerce that will drive the cloud demand. Okay. So the stocks that are listed down there are the stocks that we are more confident of. We did a comb through of all the S&P 500 stocks based on 3 criteria. First, we need a resilient business model. Then second, we want a strong balance sheet, and third, it must have positive cash flow. So there's very and the valuation must be reasonable. So therefore, we arrive at this stocks selection. Okay, this okay, it's just for some light moments, but I'll explain later on why I think it's significant as well. Okay, Alibaba is actually a good guide of where to invest. Okay, Alibaba did this first fundraising in 1999 from Sun Zhenyi, the owner of SoftBank. Okay, that he raised it in I think the fundraising was signed in China, in Hong Kong or China, and in Asia. Then in 2000, we had a dot-com bubble burst. Okay. The chart on the top is the Dow Jones Index. Okay. Then in 2007, Alibaba B2B did a listing in Hong Kong. In 2008, we had a global financial crisis. Of course, it started out in the US. Okay. So raised in Hong Kong, raised in China, then US collapsed. Okay. Then in 2014, Alibaba was listed on the New York Stock Exchange. And then 2015, the China market collapsed. Okay, this the chart on the bottom is the China market. Then 2019, Alibaba was listed in Hong Kong Stock Exchange, and that is like Hong Kong is like China. So 2020, that's where we are now. Okay, but okay. Joke aside, this to look closer into this chart, you can tell that actually there's when if a very big company like Alibaba choose a certain location to list, it also say something about the choice of the listing, where they choose to list. So you can see that quite a lot. They probably believe that the liquidity is really in Asia, in China, and true enough, and true as well. China is rising in importance, being the second largest economy in the world. So this will tell us. This actually will tell us that not to ignore China. China is coming up very strongly compared to US. All those tech companies that you see in US, like the video conferencing, the online services, and so on. Now you also have Chinese competitors coming up very strongly to compete, especially if the Trump continues to clamp down on Huawei and ZTE and access to semiconductors, access to tech support. Now you just make these competitors look for the alternative resources or build their own. So moral of the story is don't cramp down on your competitors, you just make them stronger. Okay, that's all I have for US. And I'll briefly run through Thailand and Indonesia to tell how the emerging markets are coping or not coping. Usually, I've been told when I start talking about Thailand and Indonesia, the audience will rush to the toilet, will do the toilet break. But so I'll keep this very short. Okay, in the Asian economies, these numbers are before the virus came by, right? So you see, look at the tables out here. Some of these countries are really doing very well. I like to highlight like the I don't know what color is this. Okay, but the strongest there's some shaded one. Vietnam GDP growth was 7%, and these are the latest number I could find, right, for each country. In Singapore, even in Singapore, our foreign direct investments last year, we achieved 106 billion US dollar. Okay, compared to China, 140 billion. Right? So you can look at the size. If you and think that we only have 5.7 million people. Okay. Then you look at the weak countries, you can find that Indonesia current account at negative 2.7% was already set of weak numbers, and China PMI was already at 40.3, and India, of course, was already starting on a very weak footing. Okay. So on this, and Thailand also was strong on both fronts, merchandise trade as well as unemployment. They kept it very low, but their manufacturing PMI was still below 50. Okay, the election and post-election events was make a big dent on the ability to grow. Okay, so why emerging markets are worrying? Because they face greater risk in the virus environment. First, they have lower healthcare capacity. They don't have enough healthcare support, trained doctors, enough beds, good hospitals, access to healthcare needs, and they are also more exposed to the world trade cycle. The goods and services are highly dependent on demand from the developed markets. So if the big countries, big economies are not doing well, they suffer. And in general, they have less access to the internet. So all our social distancing, work from home, probably cannot apply to them. Cannot imagine a hawker on the street able to work from home, right? And so there will be more disruptions and unprecedented economic costs. It's really difficult for them to cope with this current situation. And there's also a greater share of the GDP from the informal sectors. So you can these informal sectors can hardly work from home. And second, the stimulus package is very difficult to reach these sectors. So emerging economies also face greater risk in that they have a high reliance on tourism. The one great example is Thailand, that derives we estimate about 20% of the GDP from tourism alone, direct and indirect. Okay. Then also the emerging markets have it's highly dependent on the output of commodities to sustain the economies. This, you remember, these are countries like Indonesia, like our South America, Brazil, or these countries. Then supply chain and logistic disruption is really difficult for them, as they cannot ship out their goods, they just cannot move their products. Then the strong US dollar and yen impair their debt repayment capability. Most of them borrow in US dollar and yen, and as you look across the Thai companies, the gearing is actually fairly high. So it's very difficult to really find any good stocks to put your money in. So and as a even their own government, there's limited financial resources to cope with higher healthcare demand. Okay, this is just to show when China was down with the virus, these countries were already being hit. Okay, this table is taken from the UBS. Okay, the Hong Kong UBS estimated that Hong Kong derive about 8% of their tourism exports to China, 8% of their GDP. Thailand is the next highest at 3%. In Thailand, Vietnam, Singapore. So we are actually really very dependent on Chinese tourists. So when they don't come, we had a problem. And then China, during SARS and now is a total different size, right? China, if you look at the rightmost tallest column, China is now taking about 70% share of the global metals demand. So this is the metals export is really the main revenue earner for the emerging economies. And in terms of China global oil demand also, China takes up 12%. And in fact, China takes up more than 80% of last year's oil demand growth. So and China's share of the global tourism is 20%. So when China was down, actually we had already felt it. Okay. Then when this virus hit, the cash flow, cash crunch, it's just the fear just drove all the scramble for US dollar. So in terms of currencies, the regional currencies were very badly hit. Except for Japanese yen is up. The rest, especially Indonesian rupiah, is down nearly 15%. Australian is down nearly 13%. And Thai baht is down more than 8%. Copper price is something we use to gauge, it's a good gauge for manufacturing, especially for manufacturing activities, especially for the health of the economy in China. And China price has actually collapsed, has not recovered. So to know whether as we believe the next recovery will be led by China. This chart will tell us when we see China is picking up again. Indonesia is a big CPO exporter, just like Malaysia, and CPO consumptions are taken up mostly by China and India. And this is the CPO price. It was growing nicely late last year as the output was cut back, and as the planters cut back on the use of fertilizer, so the trees were producing less. But this CPO price has also collapsed. This CPO price is also in Indonesia is correlated to the oil price, because in Indonesia, the President Jokowi has actually managed to persuade the users, the drivers to use biodiesel. And they also subsidize the CPO producers to produce biodiesel. So this CPO demand had at least has some good support. But right now with oil price so low it fall to about $20 per barrel right now, the CPO will not be able to see any growth from here. Okay, so this is coal price. Coal price also the same because it's used for generating electricity for power. So it's also closely correlate to the oil price, and coal is also tumbled. So the emerging market strategy, the near-term outlook remains challenging because we see an ongoing capital outflow. Foreign investors are not likely to get in there, especially with a weak currency in play. And we also have a weaker export outlook going forward until we see probably only a if we see a recovery from China. And we don't know how long this virus will last and how long this emerging market will take to cope with the virus. So we recommend to still stick to defensive, which are consumer staples, telecom, and resources. In Indonesia, it faced headwinds like weak rupiah, and the bond yields are rising. Lenders are asking for higher returns, and low oil price impact coal prices, impact CPO, and reforms will likely be delayed. So the stocks we stick on, if we want to keep investing, will be PT Telkom, Gudang Garam, United Tractors, Cement Indonesia, Indofood, CNP. In Thailand, headwinds are the lockdown. Okay, the emergency degree will last till end of April, so you probably cannot. The tourism no longer exists. There's insufficient fiscal stimulus. They had 2 rounds now so far. They need further rounds. I think it will not be sufficient because the population is so used to taking handouts from the government, and the political instability is always a worry for us. So therefore, don't have good ideas in Thailand. The one stock we will probably stick on, if we have to buy anything, will be CP Food. Okay, that's all I have for my presentation. Please feel free to drop us your questions. We'll be around to answer them.
Thank you, Peggy, for your insightful sharing. So we will go ahead and take some time for questions now. So the first question, do you think the massive debt bubble created globally will cause a major recession, worse than what we have seen in recent weeks once the bubble bursts?
Do you think the massive debt cause a major recession? Okay. Thanks for the question. I personally, I didn't feel it's so. I think we sorry, the question keep running away. Okay, we are okay. Thankfully we have the low interest rates to help tie us through, and as all this selling takes place, there's a lot of liquidity in the system, and the government keeps providing stimulus, which actually just means that they're printing print out more money. So I don't. We see a recession, but we believe it will not be as bad as the last one, mainly because this time this virus is not due to a weakness of the financial system. So if we manage to cope to fight it, like Paul said yesterday, bet on us. So I think we will not we're not as bearish to think that it will be like the last. Okay. Do I read the next question, Mai?
Yes, you can go ahead and choose your own questions. Yeah.
Oh, okay. So, and how to buy the China index from Poems? Oh, this one I'm not sure. I'm so sorry. I get one sales guy to contact you, right, Mr. Chung. In view of the U.S. economic condition, do you see the U.S. dollar strengthen or weaken against the majors? Really, the U.S. dollar technically should weaken. I mean, go by the economics textbooks, and going by the way Trump react, we see it weakening towards the end of the year. Because again, with the stimulus, it just means that there's more papers, more US dollar being, more liquidity in the system. Okay. Sorry. Next question. Can you share which are the likely sectors to front run into recovery? Thanks. Okay. As fund managers, we cannot front run, but okay. But anyway, that's a joke. Into recovery, I think first we have to understand what will bring about the recovery. I think the main thing is when the virus is over, there will be infrastructure spending. That's one thing. Second thing is that there will be a change in the way we behave. So there will be online services will become more acceptable, and we will be used to not seeing each other so often. So those services will become more in demand. So and of course, 5G is something that we think will change the landscape and will drive the replacement demand for mobile phones. So maybe the one sector to watch is semiconductors. With the beach industry that's corrected punch, are there opportunities that surface? Why has the US market rebounded so strongly despite headwinds? Okay, the we haven't. I looked through all the beaches. I haven't seen anyone that looks interesting at the moment, mainly because some of these have the balance sheet are very weak, and also the revenue disappear will affect their ability to service their debt. So at the moment we haven't seen anyone that has any opportunities. The market has rebounded. There is actually I when the market rebounded also is a very narrow rebound, if we can call it. Going back to the same few names that we have, those three sectors that are on top of the S&P 500 in my table just now. So I think the market has not actually factored in the economic environment. Also because we haven't seen analysts revising the earnings numbers. The earnings revision have not come out yet. When progressively they run those numbers out, then the mood will turn negative again. Good to buy for such related shares, but must holding power to the right wave till it rises again. I'm sorry. I guess yes. I think the answer is yes. And must if this is not going to be an immediate profit. It's probably more like a U curve. So February, so second quarter, we were expecting a very sharp recession, about 10%, negative 10% in US for GDP growth. So the only recovery will probably in third quarter. So you will have to sit tight. According to the WHO, together with the International Agency for Research on Cancer, has classified all radio frequency radiation, of which mobile signals are a part, as possibly carcinogenic. Wouldn't this affect the overall tech sector? Oh, wow, this is very difficult for me. I'm so sorry. I never gone into science. I've never done any research work in my but this tech we have to define tech. It covers many areas, not just equipment. It could be like well, I sorry, I don't know how to answer this question. Maybe you can drop me an email. I'll find out more details and get you the answer. How the euro dollar will impact when the Fed funds are 0.25? Euro is a sad story. It's even worse than US. They 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 cannot even agree on how to come up with a stimulus package properly. So I think but whatever Fed does, Euro will still be bad, whether Fed do well or not. Okay, recent index keep going up and the COVID-19 will reach peak soon, I guess. What would be the event will bring the stock go lower than previous low? Okay, if there's the COVID-19, there is still go back to the focal point of the virus data, and also how the the government of each country is handling it. So as you can see from China, as soon as they managed to prove that they can solve problems and they got out of it, the Chinese stocks actually done better than the other markets. So progressively, whoever reports better results will score and become a A student. So if if they fumble and mess up, then the stocks will drop. I guess. Sorry, it's very probably didn't answer your question, but that's how it works. The What's the consensus on market in healthcare? Consensus. Are you talking about earnings consensus or recommendation? Sorry, I'm not sure how to answer this. Okay, next one. Will the U.S. equity will the U.S. equities market be as volatile within Dow 1,000 to 1,005 in April when more data are released and after pricing in the 2 trillion bill by Fed Treasury? I think it will be volatile because now at this point they're already saying that this 2 trillion is not enough, that they might be looking at some more coming up. So the market will be volatile, especially as we see more and more earnings released and more earnings being reported. U.S. banks fundamentals still strong and safe to invest during this period. Okay. U.S. banks is one sector I don't dare to venture in right now because then again it comes back to the same question. We don't know how low the rates are falling, and we are also not very sure what is the credit cost, how much credit cost going to rise, and what is the how the banks going to cope with this new heightened risk. So definitely they are stronger this time, banks compared to the global financial crisis. But I would not probably wait a while until I'm certain on my numbers before I will recommend US banks. What is your view on the cruise and airline company? No, don't look at it. Is the airline you need the government to bail you out, just like Singapore Airlines. And it's if you step away, just even without the virus, the airlines is a very it's a very difficult sector to operate because first you must keep upgrading your aircraft and make sure you have the best service, best equipment in order to attract your passengers. And then passengers are reluctant to pay more, and you have and every time whenever you upgrade your service, you still have to be offering. You still have to watch the budget carriers and how they are pricing to price your product. So it's very tiring for airlines. Worse than fund management. I think amongst the 11 sectors, there should be three types of play: the defensive, most affected, moderate. Am I right to say that? Defensive beneficiary is healthcare, industrial, communication, consumer staples. Most affected consumer discretionary, energy, financial, real estate. Moderate basic material, utilities, IT. I uh, possibly yes, depending on how you interpret the defensive and moderate. But my table is defensive, cyclical, and growth. I usually use that way to do it. But if you if you are used to this, I think it should be okay. It looks reasonable. Okay, next one. If coronavirus around the world is subsiding, and when do you think it is a time to beach again? I think to beach again, you must get the airlines to start flying first. And airlines to start flying, they have to first make sure get their balance sheet repair. So it's dependent on many factors. So I don't uh, unlike SARS the airlines the flights were not cut. So the rebound was sharp. But this time we have the airlines cutting flights, and that don't just affect tourists, they also affect the cargo. So actually the supply chain is also disrupted because semiconductors they take airplane, they don't take the ship. So to answer the question is you still need the airlines to open up and the country to be confident enough to accept new uh, to accept outsiders into the country. Next one, my thought whether a stimulus will help to speed up the recovery. Uh, it does, because stimulus at least it provides the liquidity. Actually, just make sure that when there's no run on the bank, and then make sure that there's a swap line in place so that especially during this time when the demand is really for the US dollar. But I think after this virus is over, or this outbreak is over, maybe the world will start thinking whether they should be so dependent on US dollar. Maybe they should find another currency to peg their goods and services. What the Chinese tech companies that are recommended things? Oh, okay. Maybe I can refer you to tomorrow's webinar. My Hong Kong colleague, he will be able to tell you better because he's an expert in the Chinese and Hong Kong. What do you think the current US market rebound despite the increased jobless claim and coronavirus? What do you think the quarter report will affect US market? Is the guidance going forward? It's probably going to be not favorable, and the jobless claims will affect because it actually will just means that just point to us how many companies are actually in trouble and how much unemployment will rise. Unemployment, hopefully, there's projection out there, unemployment might go up to 7%. But if the projection will be revised upwards, that will be worrying for the market. Will recession happen in US? Yes. And finally, affect US banking sector. Oh yeah, of course. Yeah, yes. What sectors and subsectors do you like in emerging markets? Okay, emerging markets. The worry is their currency and the debt burden that they have. If the sectors, of course, is still go back to resources because they are the strongest. and of course, in this time, maybe the telcos will still continue to do well, because nobody wants to cut their phone line, even if you lose your job. With a large amount of EMs being greenback, can we expect an increased default rate on corporate bonds in this low interest rate environment? Yes, that's the worrying part, because the bonds yields are rising. Lenders are asking for higher returns. Even though the interest rate is low, the risk premium has been led onto it. Notice that none of the FANG stock is on your recommended list. Is it due to high valuation or other reasons? Yes, it's the valuation that I think could come down further. Yeah. Could you advise on the equity repo market in Indonesia? Why are there large dips in share price even though there is not much volume traded? Equity repo, or actually, I'm not quite sure why there's not much volume traded and that the prices still drop. But what I can tell is that foreign investors like ourselves, it's a capital outflow. Most foreign investors are pulling the money out from Indonesia because of we see they will have problem coping with this virus, and they will take a long time to get over it. Why is Equinix picked instead of Digital Realty or American Tower, which is 5G related? Okay. Again, I went back to the balance sheet, and also Equinix. I think we like an exposure into data center. Okay. Digital Realty, American Towers are interesting, but I like to wait a little bit more as the prices are not as not as not as attractive. What about First REIT? Thank you. First REIT is listed in Singapore. It's okay. It's because the hospitals are all master lease. The only thing is that they have four hospitals that will be master lease. The master lease will be up for renewal. That's only the only near-term concern. Otherwise, First REIT is faster lease provides a stable income. Besides Alibaba, who are the cloud players in China market that can benefit from 5G? Well, 5G is not necessary. Okay. I think sorry. I think I could I leave this to my colleague tomorrow? He will be covering the Chinese market. I think he's more knowledgeable than me. What is your take on tech stocks in Indonesia at this point in time? I don't have a favorite names in there that I can pick. Yeah. Sorry, I looked through them, but I can't find anything that a strong conviction. For Indonesian market, what is your view on the growth potential for cigarette companies like Gota Grant? Does the company shows potential? Not much actually. This is a defensive only. I don't expect much growth from here, but then again, this company has never the earnings has always been very resilient. What is your view on Go? As we believe that the virus will be over, and man can fight the virus. So and Go, I always feel that it's not a productive asset. So I don't. I wouldn't recommend gold investment in gold. I rather put money into dividend paying stocks. Hi, can you share the S&P outlook from a technical analysis? Oh, okay. I'm sorry, I'm not good in technical analysis. I can't. Maybe I ask my colleague Wei Ren to do that in another session. Yeah. He's our technical analyst, specialist in Philip. Okay. Market in Sing and Indo rose for the last 2 days. What's your view and opinion? Okay, Sing market is really very trading very attractive valuation in terms of price to book, dividend yield is always up there in terms of dividend yield especially. So don't see a reason why it should be punished this way. Indonesia, uh, uh, Indonesia, from as a foreign fund manager perspective, foreign investors perspective, when it converts back to from the currency into our currency is usually not as profitable. So we always have some reservation in Indonesia. Can you comment on the Sing dollar versus US dollar outlook trend? We think longer term, towards the end of the year, Sing dollar will not stay at this level. It will actually strengthen against US dollar. Okay. Similar to Tesla, I see NIO is the Chinese competitor. Is this a good opportunity considering its valuation and attractiveness? Could you it's loss making, it's still loss making. I think it's not, it's still a long way it's still play catch up. So not yet, I think. No. In view of the low oil price, what are some investments opportunities? Some investment or trading opportunities. Okay. Wow. I don't I don't see any actually. I very tempted to say airlines, but then you see their airplanes all parked there, not moving. So low oil price also no use. They don't need any oil. Yeah. Yeah, sorry, I can't see any. Is the S&P recovery short term and not reflective of actual economic situation, high chance of retreat? Retreat to 2000, I can't tell, but I think the market has not factored in the economic situation yet. Will the low crude oil price affect US shale oil operator and finally cause the debt issue in US? Yes, this is the main issue because US shale oil operator, their break-even cost is about $30 to $40, and $20 is basically actually you shouldn't go to work at all. It's really shouldn't have any oil exploration. Given the big dependency on tourism for Thailand, besides CP oil, anything else you recommend? Actually, would have recommended the BTS, BDMS, all these the railway, the MRT line in the hospitals. But again, back to currency issue. So when translating back to our currency, it's no longer attractive. Do you see last week's low as the bottom? I don't think so. But I can't tell. I'm not very sure how technical chartists will read this. But as far as I know, all the bad news is still not out yet. I think Lucas meant what will be the sectors to recover early. Lucas, sorry, I got no more Lucas here already. I'm so sorry. As US stock market hit the bottom, uh, I I can't tell, but all I can say is that we still have to watch the daily new cases as well as the economic numbers that are coming out, and the measures that the central government will roll out. How are the responses of ETF reactive to this crisis? ETF were the first one to be sold down actually when virus happened. It was like virus was like an excuse for them to get rid of ETF. So actually ETF was the reason why the market fell, and then the domino effect onto the underlying equities. So blame the ETF. When is the right time to buy Starbucks and other US shares? Okay, again, it's the lockdown that's worrying us. We think the right time to is when we did. I don't know. I can't tell the right time, but I don't know when is the right price. The right price is when we see when we see things improve, when we see the a near almost a light at the end of the tunnel, when we see some sign of recovery, that the stores are no longer shutter, they start to open up for business. With slightly higher bankruptcy due to lockdown, what is the risk on banking for bad debts or even big corporates like Boeing going to cash flow issue with plane not flying and 737 MAX issue? Yeah, this is a big risk. This corporate leverage and as well as the cash flow are two big risks for the market. With all the poor US economic numbers, do you foresee there will be more market downside from here? It's a concern. It's a concern, but it's really depends on this unknown, unseen virus. How it's going to act on the market. Yeah, it's so powerful. And it's invisible. That's the scary part. In your view, what will be the impact of COVID-19 on Alibaba, Apple, Microsoft, and Visa? Apple, with the supply disruption, will affect their rollout or the launch of the new products, I think. So there will be a pushback in their revenue. Microsoft, Alibaba might benefit from some additional cloud demand, but then also they need to work very quickly to meet those demands. Visa, I believe it will be a later at the time at the point of recovery, then it will shine. COVID-19 has to go off first. Could you give your comments and advice on the financial sector, in particular banks for the countries represented? Okay, no advice. Comments is that I really then again it's the how much of that COVID-19 actually affect the businesses balance sheet, and then in turn will affect the bank's loans books as well as their credit costs. So that is something we haven't been able to put a number down. So at the moment, what you see the bank's share prices are being back down because we just it's just numbers all over the place. So until we get to know where rates are falling, how much rates at where it will land, and what are the packages, the relief stimulus that will come up that will help the economy. It's very difficult to put a number onto the banks. Which semiconductor names do you like? Foundry, test, assembly, chip manufacturers? And for chip manufacturers, is AMD too expensive at this point, or can you see increased growth? Yeah, I think the foundry actually which actually their valuation moves very, it's very volatile every day. So AMD, we like the company, but yes, valuation is something we can go lower. But but uh, I think the semiconductor sector will do well, even the DRAM makers. If you look at some of the US biotech stocks recently benefiting from coronavirus, any value or potential there are or they very overhyped. Okay, this again. Well, when we value a company, we need to have a handle on the revenue, on the earnings, and for these companies, most of the price has ran up because they make some announcements about they are near to this stock, near to this drug, or they're almost there and so on. So there's really nothing that we can hold on to get poor valuation onto it. So it's just we can't value hope. I can't value um yeah, we can't value that. So therefore it's really difficult to say whether it's a binary thing, whether they get it or they don't. So the risk is there is very high. Do you think this is a bull market or market will test the recent low again? Don't think, not yet a bull. I think I don't see anything that's going to that makes this round different from what we saw before the virus. Do you think that oil price will tank further coming months? At what level do you expect the oil bottom? Oil price really depends on how these three boys sit down and talk. Um, very difficult to call oil prices. And then if they overnight decide that they just turn off the tap, don't produce, that's also possible. So I can't tell where's the bottom. What are some investments or trading opportunities given current low operations? Yeah, I can't see any. I wanted to say airlines, but then the aircrafts are not flying. My office is very near to the airport, but can't hear any planes flying around. Can you elaborate what you meant by analysts revising the projection? Are you referring downward variation when the pandemic is more? It could be upwards, could be downwards. We revise as we get some information, some more data points. Now, at the moment, the goalposts are shifting every day, so therefore we cannot be very accurately to tell what is the valuation for the market. Okay. What do you think the length of recession will last in Asia, Southeast Asia? This year, yes, I think this year. Next year we'll have some. Will look better. Can you share with us your strategy on protecting against volatility and big drops in market? We are expecting a sharp decline. Okay. We will, because we believe that because we always invest for the mid to long term, so between 3 to 5 years at least. So in this kind of environment, we should just move into defensive and just for those companies that there are some companies can still be paying dividends. So move to the defensive and just be ready to move into the cyclicals when time is right. Any
Okay,
comments?
yeah,
Okay, yeah.
thank you, Peggy. Thank you for your time. And thank you,
Okay.
everyone, for joining us for today. So, if you have any questions or you want to know more about managed accounts, you can just send an email to maenquiries@philip.com.sg. So, you can also join us for our upcoming webinar tomorrow, 12:30 for Japan Outlook, 7 o'clock for Hong Kong and China Outlook. So, that's all. Thank you, everyone.